Do you want exposure to an exciting area of technology? Also want a market-beating dividend growing at an inflation-beating rate? Like the idea of getting a good deal on a high-quality stock? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high-quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is engaged in owning and operating data centers. The world is becoming increasingly digitized. You already know this. The very device you're using to watch this digital video on is proof of that. And companies that cater to the future of society and technology are poised to profit. They're also poised to reward their shareholders with dividends. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Digital Realty Trust Inc., which appear to be trading at a significant discount today. Digital Realty Trust Inc., stock ticker DLR, is a global real estate investment trust that owns and operates data centers. Founded in 2004, Digital Realty Trust is now a $41 billion by market cap data center behemoth that employs nearly 3,000 people. Their real estate portfolio of over 290 data centers is spread out across 24 countries on 6 continents. These purpose-built properties are strategically located for their networking capabilities. Their global platform has over 4,000 customers. Some of their largest customers include IBM, JP Morgan Chase, Uber, and LinkedIn. When investors typically think of a REIT, their minds might initially conjure up images of shopping malls and office space. Well, this REIT is nothing of the sort. Its differentiation positions it squarely in the middle of the ongoing technology evolution, which involves almost every facet of our lives. See, everyday life is becoming increasingly digitized. The internet is now an essential part of most people's day-to-day lives. We practically cannot function without it. And with the Internet of Things expanding into everything from smart homes to self-driving cars, our future is going to be more digital than it's ever been. AI, data, cloud, IoT. That's where society is going, and that works to the advantage of companies that own and operate data centers. These data centers act as critical infrastructure, allowing the global flow of information through interconnected networks. Digitization doesn't happen without data centers. The company was in a great position before 2020. They're in an even better position now. That's because the pandemic has only accelerated digitization. I'll give you a quick example of this. More companies are starting to offer flexible work-from-home schedules for their employees. This was probably inevitable, but there's been a forced move in this direction over the last year. Well, remote work will require people to be even more reliant on digital tools than they were before, and Digital Realty Trust stands to benefit from the accelerating evolution in the way people live, work, and play. All of this bodes extremely well for the company's long-term ability to grow its profit and dividend. As it sits, Digital Realty Trust has increased its dividend for 17 consecutive years. The 10-year dividend growth rate is 8.6%. The stock's current yield is 3.2%. I think that's a very nice combination of yield and growth. By the way, this yield is more than twice as high as the broader market's yield. It's also within 30 basis points of the stock's own 5-year average yield, and the payout ratio is a reasonable 71.6%. That's based on midpoint guidance for this fiscal year's funds from operations per share. I like dividend growth stocks in what I refer to as the sweet spot. That's the yield of between 2.5% and 3.5%, paired with a high single-digit or better dividend growth rate. This stock is definitely in that spot. Looking at business business growth, Digital Realty Trust grew its revenue from $1.063 billion in fiscal year 2011 to $3.904 billion in fiscal year 2020. That's a compound annual growth rate of 15.6%. Highly impressive sales growth here. However, REITs often fund growth through equity and debt. The former means share offerings or dilution. That's why per share profit growth is much more insightful when looking at a REIT. Furthermore, when looking at profit growth for a REIT, you should be looking at funds from operations instead of normal earnings. Funds from operations measures cash generated by a REIT. It adds depreciation and amortization expenses back to earnings. The company increased funds from operations per share from $4.06 to $5.11 over this 10-year period, which is a compound annual growth rate of 2.6%. We can now see a material difference between absolute top-line growth and the relative bottom-line growth. Dilution accounts for much of the difference. The outstanding share count has more than doubled over the last decade. That said, I don't see this result as accurately indicative of the company's true growth profile. Fiscal year 2020 was an aberration for many reasons, but the first quarter of 2020 in particular threw their whole year off. In addition to the uncertainty that the pandemic-induced shutdowns caused in early 2020, Digital Realty Trust closed on its $8.4 billion combination with Interaction in the first quarter of 2020 and reported a very skewed Q1. The timing was unfortunate, but the tie-up with Interaction gave Digital Realty Trust much-needed scale in Europe. The truth of the matter is that we can't make money on yesterday's results. We're always investing for future growth, and I maintain my view that Digital Realty Trust's future is as bright as it's ever been. Looking forward, CFRA currently has no 3-year funds from operations per share growth projection. That's regrettable. I like to compare that projection against a historical baseline for these analyses. That allows a bigger picture and future trajectory to be more easily fleshed out. However, CFRA does include its forecast for both fiscal year 2021 and fiscal year 2022 funds from operations per share. They are $6.50 and $7.01 respectively. That fiscal year 2021 number would represent a 27.2% year-over-year increase compared to fiscal year 2020 funds from operations per share. And the fiscal year 2022 number would represent a 7.8% year-over-year increase compared to the fiscal year 2021 projection. It's that latter number, 7.8%, that I see as a pretty rational expectation for long-term bottom line growth here. If we look at normalized pre-pandemic funds from operations per share growth that isn't skewed by a significant acquisition, the compound annual growth rate was near 8%. With Interaction and its 50-plus European data centers on board, along with post-pandemic tailwinds blowing at its back, Digital Realty Trust should be able to do at least this well over the coming years. And that sets them up for dividend growth. Moving over to the balance sheet, the financial position is good. I will note that the balance sheet has swelled over the last few years with Digital Realty Trust scaling up through acquisitions. The aforementioned Interaction combination is just one example of that. The $7.6 billion acquisition of DuPont Fabros Technology in 2017 and $1.8 billion acquisition of Ascenti in 2018 are two more examples. The company has $18.4 billion in total liabilities against $36.1 billion in total assets. The company's investment grade credit ratings are as follows: BBB S&P Global, Baa2 Moody's, BBB Fitch. Moreover, many of their top tenants are world-class institutions with their own investment grade ratings. Investing in Digital Realty Trust could offer you a chance to make your portfolio quote-unquote future-proof. And the company does benefit from durable competitive advantages that include global scale, switching costs, sticky assets, strategically placed properties that are purpose-built, and technological know-how. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. The company is much more involved in technology than a typical real estate investment trust. As such, they're directly exposed to the risk that technology changes faster than they can keep up with. The increase in debt over the last few years leaves the company more vulnerable to interest rates and less flexible. This business model is capital intensive. Real estate is highly cyclical by nature. This real estate is differentiated, but there is still an element of cyclicality to contend with. There's often a scarcity of durable competitive advantages in real estate, although this company's unique real estate portfolio gives it advantages that I don't usually see in real estate. The differentiated real estate is in and of itself somewhat of a risk, just in the sense that it's difficult to repurpose these properties. Even with these risks out in the open, I still believe that this can be a great long-term investment for dividend growth investors. With the stock 16% off of its 52-week high, the attractive valuation only makes the investment investment case that much more clear. The stock is trading hands for a price to funds from operations ratio of 21.9 based on midpoint guidance for this fiscal year's funds from operations per share. For an exciting tech business, that is not a high multiple. Many of the more traditional REITs are trading for similar multiples despite not having this kind of tech exposure. Most basic valuation metrics are close to their own recent historical averages, even though the company is arguably positioned better than ever before. For instance, the price to cash flow ratio of 21.5 is very close to its 5-year average of 19.5, and the yield, as noted earlier, is close to its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 7%. This dividend growth rate is higher than I generally allow for when valuing a REIT, but I think this REIT's specialization and differentiation warrants it. It is lower than the long-term demonstrated dividend growth. It's also lower than their normalized funds from operations per share growth, and it's lower than the funds from operations per share growth that CFRA is forecasting over the next 2 years. With the payout ratio at a moderate level, I view the company as being capable of this kind of dividend growth for the foreseeable future. The dividend discount model analysis gives me a fair value of $165.49. The reason I use the dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since a dollar tomorrow is not worth the same amount as a dollar today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Digital Realty Trust as a 3-star stock with a fair value estimate of $130. CFRA rates Digital Realty Trust as a 3-star hold with a 12-month target price of $170. I came out slightly below where CFRA is at. Averaging the 3 numbers out gives us a final valuation of $155.16, which would indicate the stock is possibly 9% undervalued. Here's the bottom line, guys. Digital Realty Trust Inc. is an atypical REIT that has exciting exposure to the future of technology and society through its strategically located, purpose-built data centers. With a market-beating yield, high single-digit dividend growth, a reasonable payout ratio, more than 15 consecutive years of dividend increases, and the potential that shares are 9% undervalued, this stock is worth consideration by dividend growth investors. And now for a special news announcement. JPMorgan Chase & Co., stock ticker JPM, just reported great Q3 results. Earnings per share came in at $3.74, beating expectations by a full 74 cents. That's 356% year-over-year growth in earnings per share. Bad comps, sure, but JPMorgan Chase remains a powerhouse. I analyzed and valued the firm back in late July when it was around $150 a share, showing why shares could be worth nearly $165 a share each. If you don't already have JPMorgan Chase in your portfolio for the long term, consider changing that. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so that you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.